dive today into an analysis titled QQQ, the DIP you've been waiting for. Don't miss this. And I mean, that title alone is just so high octane.
It really is.
The analysts here are strongly advocating for a definitive buy the dip strategy. Right now, they're arguing this minor pullback is a prime accumulation opportunity, not some signal that this historic tech rally is ending.
And our mission today is really to analyze why. Why does this report view a slight pullback in QQQ, which, tracks the tech-heavy NASDAQ 100 as such a prime opportunity? They're treating it as a strategic pause.
Yep.
We're going to try to help you cut through the noise and understand the mechanism behind their bullish conviction.
And for context, QQQ is the benchmark for the modern digital economy. It's so highly concentrated in those massive tech companies that have just led the charge all year.
Right.
When we talk about QQQ, we're really talking about the bellwethers, your NVIDIA, Microsoft, Apple. Any move here feels magnified, and it often sets the tone for the broader market.
Okay, so let's ground ourselves in the immediate action the report highlighted. Because when we say dip, we need to be very, very clear about the scale here. What specific numbers led to this intense analysis?
No, that's the thing. The dip was, it was almost microscopically small in the grand scheme.
Okay.
The report noted that QQQ closed at 620.87. That's a drop of just $3.02 for the day.
Which translates to, in percentage terms?
It translates to a pullback of just under 0.5%, 0.48% to be precise.
A move so small that on almost any other stock, it would just it'd be meaningless, right?
Yeah.
But the whole market was watching.
Exactly.
And the analysis detailed a tight intraday range I see here, swinging from a low of 618.73 to a high of 622.78.
Right, but the psychological impact of seeing red on a chart that's been so consistently strong, it's often way out of proportion to the actual price movement.
And that disproportionate reaction is the core of the report's argument, isn't it?
It is. It's the whole thing. You have to place that 0.5% drop next to QQQ's performance this year. It has surged from a low of around, $402?
Yeah, something like that.
And it's still sitting very, very close to its 52-week high of 637. So if you zoom out, this tiny minus 0.48% is, it's just statistical noise.
That context is vital. The report's entire philosophy seems to rest on how they label this minor weakness. They don't call it a setback or a reversal.
No, not at all.
They explicitly define it as consolidation and healthy behavior. They see it as necessary breathing room before the next leg up.
Exactly. And the analysts use very clear, I don't want to say harsh language to describe the market psychology they think is driving the selling.
Okay.
They suggest the morning drop fleshed out the weak hands. They aren't talking about institutional managers with multi-year horizons. They're talking about, over-leveraged retail traders or fast algo-driven volume that panics the second it sees any weakness.
So the narrative here is explicitly contrarian. If you're selling this 0.5% dip, you're emotional, and this analysis is betting against that emotion. This whole narrative sets up the three core pillars of their bullish case. So let's dive into those foundational arguments as to why QQQ, even at $620, is an overwhelming strong buy to them.
Okay, the first pillar is the longest term one. It's the most fundamental. It's the conviction that the AI supercycle is absolutely not over.
Okay, that's the bedrock.
It's the bedrock of the entire thesis. They argue QQQ is simply the best proxy for this multi-year thematic growth because of how heavily it weighs the key infrastructure providers.
And we know the names: NVIDIA, Microsoft, Apple. But why are the analysts so sure the supercycle is accelerating now and not, peaking after the massive run we've already seen?
They cite these significant projections for CapEx spending accelerating into 2025 and 2026.
I see.
The argument is that 2023 and 2024 were largely the testing and piloting phases of AI adoption in the enterprise world.
Okay.
Now, they say, we are shifting into the heavy multi-year infrastructure build-out phase. This requires unprecedented spending on semis, cloud computing, enterprise software, so buying QQQ, in their view, is like buying the engine of the future economy.
That does make a compelling long-term case, provided those massive CapEx budgets actually materialize. But what about the immediate market dynamics? This brings us to pillar 2, the smart money signal.
Right.
Which focuses on this tiny technical nuance they noted just after the closing bell.
And this is where they connect psychology directly to price action. They noted that while the official closing price was $620.87, the price immediately ticked higher in after-hours trading. It reached $621.21.
That's a tiny 34-cent move. Why is that small uptick so significant to them?
It's all about context. After-hours volume is typically really low, and sentiment is often just governed by the negative headlines of the day.
Sure.
So for institutional money, the smart money, to step in and aggressively bid the price up, even by just 34 cents in that low-volume environment, is a massive signal of conviction to them.
Okay.
The report argues that while the weak hands were panicking and dumping during the day, these sophisticated players were discreetly accumulating. It suggests the buyers who came in had deep conviction and were willing to pay up a little bit against the prevailing sentiment.
So it's the classic contrarian playbook.
Yeah.
Find these moments of manufactured weakness to buy on the cheap.
That's it.
We've established the fundamental belief AI and the institutional confirmation, the after-hours buying. Now let's bring in the final component of their bullish thesis, the calendar. They're calling it the January effect setup.
Yeah, and this timing factor is crucial, especially toward the end of December. The analysts explain that slight pullbacks like this are often just artifacts of year-end institutional behavior.
You mean tax loss harvesting?
Specifically, yeah, they point to tax loss harvesting. This is when investors sell off losing assets to offset capital gains they realized earlier in the year.
So even if QQQ isn't being sold directly for a loss, because it's been a massive winner, the overall capital movements and rebalancing at major firms can create these ripple effects of weakness.
Precisely. They might be selling a losing biotech stock, but the resulting cash flows and rebalancing can temporarily suppress buying power everywhere, including strong ETFs like QQQ.
And so this analysis report forecasts that this seasonal weakness sets up a, what do they call it, a massive slingshot move for January.
Exactly, because January is typically when all that institutional and pension fund money gets deployed. It flows back into the market, and it often targets the names that performed strongly the previous year.
So the message to you, the listener, is buying this dip is positioning yourself just before that anticipated New Year injection of capital. It's trying to front-run the big institutional flows.
It's a classic momentum strategy combined with a timing play. They're betting on predictable human behavior driving the weakness, which then sets up a predictable, strong institutional buying pattern in the weeks just ahead.
Okay, let's synthesize all three pillars, the AI fundamentals, institutional signals, and the seasonal timing, and move to the technical roadmap. The analysis report is not vague. It gives specific price levels for you to track.
All right.
So where is the critical support level they are focused on?
They clearly define the floor. They label it massive support. And that zone sits precisely between $610 and $612.
And why there?
The analysts explain that this level is critical because it represents a major psychological pivot point from previous consolidation phases, and it likely contains key technical markers, like maybe the 50-day moving average, which momentum traders really respect.
And what's the implication of that floor?
The implication is pretty straightforward. As long as QQQ holds above 610, the uptrend is intact. The bullish thesis is executable. And the fact that today's low of 618.73 was significantly above that floor is cited as an immediate positive sign. It establishes a higher low in the current uptrend.
That's valuable context for sure. On the flip side, we need ceiling. What short-term resistance level does QQQ have to overcome to confirm the momentum is back?
The short-term hurdle is defined at 626. This level corresponds to the recent peak of the consolidation pattern that came just before this minor dip.
So it's a key psychological level.
And technical level, yeah, where sellers previously overwhelmed buyers. Breaking 626 would confirm that the weak hands have been successfully flushed out and that conviction buyers are taking control again.
And clearing 626 then opens the path to retesting that 52-week high of 637. But what's the long-term potential reward the analysts are citing? Because if we're buying at 620, we need to know the ultimate destination of this AI supercycle bet.
Their forecast is highly aggressive, but it's backed by their long-term growth expectations. They project that the NASDAQ, and by extension QQQ, could hit a range of $680 to $700 by mid-2026.
Wow.
The report emphasizes this as a level of significant upside when you view it through a multi-year investment lens.
That is a massive projection, especially considering tech has already run so hard this year. I have to push back a little. Isn't that target relying on nearly perfect execution from companies like NVIDIA and Apple? It assumes very little margin for error in the economic cycle.
It absolutely relies on strong execution. But the analysis addresses this. They suggest that the growth drivers, AI implementation, cloud migration, data center build-outs, are now so powerful and well-capitalized that they insulate QQQ from typical cyclical volatility.
So they think it's almost recession-proof.
In a way, yeah. They believe the underlying demand structure is inelastic, meaning even if a recession hits, the need for these core tech investments will only slow down slightly. It won't stop. It's a very high conviction bet on secular growth overcoming economic headwinds.
That reframes the risk profile for you then. The analysts are betting on technological imperative. So let's bring it all back to the immediate takeaway. If we recap the analysis report's final verdict, the whole reason for that headline, what should you be doing right now?
The final verdict is unequivocal, a strong buy. They conclude that letting a minor, a minus 0.48% day scare you is falling victim to the exact emotional trap they identified earlier.
Right.
They view the current zone around that 620 level as a premium accumulation zone.
So the actionable takeaway is clear. Days like this, which effectively create a temporary discount by flushing out less informed traders, are cited as the exact time to add to a long-term position, specifically targeting the AI theme.
Yep. And for the short term, the condition to watch for tomorrow is simple. Watch for that bounce and ensure the intraday low of 618 holds.
What's fascinating here, though, and what you should really mull over, is the reliance that the analysis places on the timing. This expectation of massive institutional flows hitting the market in the new year and creating that slingshot effect.
It sets up a fundamental question about market efficiency and forward positioning, doesn't it?
It really does.
It does. If the analysis report is correct about this inevitable slingshot move for January, how much earlier does the market need to start moving before those institutional flows become visible in the high-volume public trading hours?
Right.
Does that slight after-hours uptick we saw, the move to 621.21, does that already signal the true beginning of that institutional positioning? If so, waiting for the headlines might mean you've already missed the early, most strategic window to buy the dip. That's the timing question to consider as you look ahead.